One of the ways of passively investing in commercial real estate is investing in REITs or real estate investment trusts. It is a great way to get exposure to real estate if you have limited funds to invest, want a lower barrier to entry, and like the flexibility to buy and sell your investment at any time. Let's find out some of the pros and cons of investing in REITs. Stay tuned. REITs or real estate investment trusts were created by Congress back in the 1960s to give all Americans an opportunity to benefit from investing in income-generating real estate. Now, REITs allow anyone to own or finance properties in the same way shareholders benefit by owning stocks in corporations. So, the stockholder of a REIT earn a share of income produced through real estate investment without having to buy or finance a physical property. Now, REITs are mainly categorized in two types. Number one is an equity REIT and number two, mortgage REITs. So, REITs are precisely publicly registered equity or debt instruments that are in real estate asset types, and they may or may not be listed and traded on major stock exchanges. Even some private companies could offer their own REITs, which may not be registered with the SEC. Now, more on REITs in detail in another video, but for now, let me introduce you to the 5 main reasons why passive investors love investing in REITs. Number 1, diversify portfolio. Since real estate is a sector in itself, it is not directly tied to other markets like stock market. Now, REITs may or may not be affected much with the daily volatility in the stock market. So this is one of the ways to diversify from the stock market or other type of investments. Now, during a certain period, if some of the investments are underperforming in your portfolio, REITs could be your savior. So make sure to check your retirement accounts or other ETFs that you are already invested in, because these could actually give you exposure to REITs already. Number 2, liquidity. In my opinion, physical real estate is the best option, but it is not the most liquid asset. So if you want liquidity and still want to diversify in real estate, REITs are your best option. Now, you can buy and sell them on public market anytime. Number 3, affordability. Physical property needs a reasonable size of cash as a down payment and a steep learning curve. So you can get started in REIT investment with a small amount online. Number 4, dividends. REITs are known for paying out pretty healthy dividends, monthly or quarterly. REITs are required to distribute at least 90% of their taxable income annually to all the shareholders as taxable dividends. So in other words, a REIT cannot retain its earning. This is a good source of some passive income. Number 5, passive income. If you do not like to deal with the operations of underlying asset on a day-to-day basis, this is the most passive you can get in terms of investing in real estate. Now, what are some of the challenges of investing in REITs? Number 1, interest rate risks. Real estate is sensitive to rising interest rates. Since most of these REITs are going to acquire properties through debt, when interest rate rises, it becomes more expensive to borrow that money to purchase additional properties. Now, if and when Fed will start increasing the interest rate, the prices per share of the REITs will take a hit. Number 2, tax risk. The taxes that you will pay on dividends received from REITs are taxed at ordinary income tax rate, even if you decide to reinvest it back into the REIT. So these dividend payouts could bump up your tax bracket to a higher range. Of course, there are a couple of workarounds, which is by holding your REITs in tax deferred or tax advantage accounts. like 401ks, IRAs, or Roth accounts, but definitely talk to your CPA to get some guidance based on your specific situation. Watch out for my other videos in this series explaining different ways of investing in real estate in detail.